Well, and just like that, we're back. We're so back. ASML lit a fire under semis and put technology back in the spotlight after a brutal start to the week. With some of the big tech names also reporting very strong results and earnings living up to the hype, we now need to start asking the big questions. Where does this leave us with valuation and return expectations for the rest of 2025? Because for every tailwind, there is also a headwind. And with DeepSeek casting a cloud over the AI spending paradigm, this market is becoming ever more so grounded in the fundamentals and the macro. So what exactly does this all mean, and where do we go from here? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US tech stocks led the market lower on Wednesday as the broad market mood stayed muted after the Federal Reserve's latest interest rate decision, which saw the central bank keep its policy rate at 4.25 to 4.5%. They paused today, and as a result, the market was very volatile across the board, particularly with some of the earnings we saw. Now look at Nvidia, down 5%. At one point, it was actually up today. AVGO followed suit, so too did Microsoft and Oracle. However, AMD was up 2.83%. And look at the equipment manufacturers and hardware names, very positive going into ASML's earnings, and we're going to talk about that a little later on in the video. However, software didn't follow suit, but after yesterday's huge rally in software really breaking out, we just saw a little bit of a give back, except for ADP, which reported their earnings up 1.64%, and that really goes to show the outstanding earnings there. Financials, however, actually did buck the trend. They were actually largely positive in light of everything. Google and Meta were the only two mega caps that were in the green. Tesla really taking it on the chin. Amazon was kind of flat, so too was Apple. So very mixed price action in the big names, but sectors as a whole held up pretty well. Now, the majority of sectors were either flat or gained today. Now, you can see here the XLI, XLY, right? Down 0.3%, so pretty much flat, inconsequential, really. Then we saw the XLE, XLF, XLP, staples, utilities, communication services. They all gained here on the day, to see the S&P 500 down 0.24%. Now, this was the majority of these declines coming from the tech space right here, down 0.68%. But on the back of a rising dollar and rising yields with the Fed's statement today, we actually did see real estate 4.77%. And some of these rate-sensitive stocks like materials and healthcare, they did fall as well. So, there were cyclicals in the lead today. There were defensives in the lead today. There were also defensives getting sold today and defensives getting bought today, as well as sensitive stocks in the mix. There wasn't really a trend today. There were winners, there were losers, and that was true across the entire market today. We did see some bright spots. Large cap core was up 0.48%. That's mostly financials in this sector, and mid cap growth was pretty much flat here, slightly up. But what we really saw today was sort of just a digestion from yesterday. Yesterday, we had this big rally from the lows we made on Monday. And what we really saw was a little bit of digestion today. Look at this, down 0.1% in mid-cap value. Same here in mid-cap core, small cap value, small cap core, small cap growth, just down ever so slightly. What really took it on the chin was simply just large cap growth right here. And that did affect the overall market, but largely all the other parts of the market were actually slightly green or just barely red, despite all of the volatility. So it was just another day of outperformance from the broader market. And this was again on the back of the FOMC statement. Now, the Federal Reserve kept its interest rate unchanged, Fed funds at 4.25 to 4.5. Now, the biggest initial development out of the Fed's policy statement and the FOMC press conference on Wednesday centered on a shift in the wording of the final sentence in the first paragraph of the Fed's statement. In December, the central bank said inflation has made progress towards the committee's 2% objective, but remains somewhat elevated. The removal of the phrase "made progress" was not received well by markets, and stocks moved to session lows shortly after the release of that statement. Very irrational behavior, but that is the market we're in right now. Everything comes down to where we see the rate cut picture, and for the market, that means we probably are going to go on a little bit of an extended pause. But Jerome Powell did come out and say some other very positive stuff, in my opinion, and that's why we saw quite a lot of volatility into the close. Powell said the labor market appears to be settling at a stable level and broadly in balance. Powell cited that moderating shelter inflation as further progress towards the Fed's 2% goal, and I quote, "You see that coming down pretty steadily now, and that's the place where most of the remaining inflation gap." And Jerome Powell also said that there remains elevated uncertainty in tariffs, immigration, fiscal policy, and the regulatory policy, and they're gonna take those policy changes as they come. So broadly, I think there were good things out of this press conference. I think the market reaction was a little bit silly initially. Nonetheless, onward and upward, the Fed funds remains where it is right now. And from what the market sees, we're still on track to see 1, maybe 2 cuts into 2025, which I still think is a little bit hawkish, but we'll see as the year progresses. Now, looking at other market movers, Nvidia was down 5% today. Now, at one point here in the pre-market, they were actually kind of positive, looking flat, and then we just saw lower lows and lower highs, pressuring the tech sector after a report that the Trump administration was weighing further additional curbs on exports of its chips specifically to China. Now, this was on the back of ASML stock, which rose nearly 6% after the Dutch semiconductor equipment company posted better than expected fourth quarter earnings results, and its CEO dismissed the concerns about DeepSeek. ASML beat on the top line, beat on the bottom line, and also posted a much better than expected order bookings. They call it net bookings, which just reflects stronger demand for its chips. And then its CEO came out on CNBC and just said the DeepSeek impact is simply opportunity for more chip demand. Now, ASML was up 5% on this news. At one point, it was actually up like 9-10%, specifically in the pre-market, but coming off the highs on the back of the FOMC as well as the Nvidia sentiment. Now, a stock that completely bucked the trend was Starbucks, up 9% here, and the Brian Niccol transformation is really in focus. Now, Brian Niccol came out and he promised more caffeinated growth and growth as a whole, but he wasn't ready to put hard projections to paper just yet. And actually, that was more than enough for Wall Street, and the stock making higher highs, higher lows into the close. And I think this is going to produce a sentiment boost for the rest of 2025. I think we can see 120 in this name before the next earnings, next quarter, in the next 3 or so months. And you can definitely see Starbucks is in the middle of a turnaround. All of their comps came in better than expected. However, the earnings was still a bit of a dumpster fire. There was still same store sales growth was still in decline. There was still a lot of parts of the business they were not happy with. They still have a lot of debt on their balance sheet. However, Brian Niccol's been with the company for about 4 months, so he's working on a turnaround. And for everything we saw today, we saw market breadth deteriorate ever so slightly. We saw 3,700 decliners, 2,500 advances, and market momentum also deteriorated ever so slightly. We lost the 100-day moving average, so these medium-term trends looking shaky, so too do the short-term trends, but the longer-term trends remain intact. Now, looking at the charts, guys, do be aware that we are about 10 minutes away from the market's close, as you can see right here. Now, very interesting development. The S&P 500 actually down 0.52%. Look at the NASDAQ 100. Actually kind of flat here today. However, look at the Qs. So the Qs is actually the ETF traded in the market. This is just the index, right? This is just an index provider looking at the price of all of the constituents and then spitting out a number right here. So the NASDAQ 100 actually flat. Very, very weird to see that in comparison to the rest of the market, especially with Nvidia being down. Nonetheless, interesting developments right there. The IWM kind of flat as well, down 0.13%. It's an inconsequential day, really. The RSP down 0.27%, slightly worse than the IWM. You can see mid caps, small caps. And today, from my opinion, this just looks, everything we see right here just looks like a digestion from yesterday, right? If you just look at it, we had a massive gap down, then we had a rally off the lows on Monday, a very, very big rally here on Tuesday. And now we're kind of just digesting a lot of the gains with all of the volatility and earnings that we actually got today, right? Completely normal. I wouldn't take this as, this trend continuing, because if this gap down was a continuation of what we saw, we would really need to see a close below yesterday's open right there yesterday's low or even Monday's low, and we simply did not see that. We still are in positive gamma here in the S&P 500. And look at the NASDAQ 100, guys. Very similar situation. If you want to see a continuation of the downside we saw, you want to see these lows being undercut, and you want to see those lows being undercut like today or tomorrow. If these lows are not being undercut, and we did see buyers come in a very big way, you can see by this wick, this massive wick, and that is true for the S&P 500. It's simply not a continuation of the trend. It's just a digestion from yesterday's stocks. When they make big moves, they normally digest. Now we are seeing a little bit of volatility here in the after hours. The NASDAQ 100 has gone from pretty much flat to down 0.11%. The IWM now virtually flat on the day. It's going to be very interesting to see where the market closes. The S&P 500 now down 0.47%. And again, like I say, just a digestion day. Now the S&P 500 continues to be in positive gamma, and you could see because the bulls came in, bought the dip, that's generally positive gamma behavior. Same is true with the NASDAQ 100. And with the NASDAQ 100, we're actually very close to the close. Now the RTY, the IWM, you can see sort of bouncing here off the gamma flip zone. This is looking largely constructive, and none of these levels have actually moved. That's very, very interesting. These move automatically on my chart every single day, guys, and none of them have actually moved. The exact same levels apply for the S&P 500, the NASDAQ 100, and then the RTY. And this is essentially telling us that the options market is in a wait and see mode. They're not getting ever more so bullish. They're not getting ever more so bearish. They're just looking to wait and see. And I think what they're really waiting for was two things: the FOMC press conference today, as well as big tech earnings, Microsoft, Nvidia, Tesla. They report all after the bell. Now we're about 8 minutes away from their earnings report, so we'll see how their earnings reports go. Nonetheless, guys, we see some very, I think, constructive price action when you look under the hood, excluding the S&P 500. Now we're seeing a lot of volatility into the close, but I think this is genuinely constructive price action given the moves we saw here in the week until we actually undercut the low of the day and maybe Monday's low. I think you want to buy these dips. Why do I say that? Because it's right here at the gamma flip zone. If we undercut these lows and get into negative gamma, then you can start looking at very bearish scenarios. However, we're not there just yet. And until that actually happens, then I would consider looking at bearish scenarios. But right now, things look largely constructive in my opinion. Now, we are coming a bit down here in the after hours. It's very weird to record these videos during market hours because things change so dynamically, especially with the volatile day we've had. Let's just look at the RTY. Look at the price action we've had today. I'm just zoom in right here, okay? So this is where the market opened, 9 a.m. right here. So the market opened in a flurry right after ASML's earnings. Net bookings were fantastic, right? And every stock rallied. Then we did see a little bit of a digestion period here. We traded flat into the FOMC, and then what happened? Jerome Powell said some words, the market pulled back, and then he said some positive words, and the market rallied, actually broke the highs, created the press conference, right? Then he said some more negative words, and then the market came down, and then he said some more positive things, right? And now the market's where it is. Definitely a day for the day traders, and if you're a long-term investor like me, like most people on this channel, all you really are doing is sitting and just waiting for these days to pass, on the days like we had with the S&P 500 on Monday, where, stocks are down 2, 3, 4%. You took the opportunity to buy at the gamma flip. You've made money since there, and now you're just in a wait and see mode. And really, the FOMC is behind us. That uncertainty is now certainty, regardless of what the market thinks, regardless of what happened and what was said. That uncertainty is now certainty, and we now just have to look to earnings for the remainder, as well as some of the economic data we get tomorrow and the day after tomorrow. But the big thing above everything is 100% earnings that are coming out in about 5 minutes. Meta, Microsoft, Google, as well as some of the other earnings are in tomorrow's video. But where do I see equities right now? There's not much more to say than what there was from yesterday. We're in positive gamma in the S&P 500. Any moves to the gamma flip, you want to buy those, but it looks like there's still a little bit of upside here for us to get to the core wall. Ultimately, this is what we're targeting, the 6100 area, and it looks like we're on our way there in the S&P 500. The NASDAQ 100 as well, we're looking to the top end of the range, 21,915. As you can see, that's where we're going now. We really do need to go ahead and break this level, because if we don't, this simply lends itself to a lower high, and then we just be making lower lows, and that's not really constructive. However, we actually did put in a lower high right here on this drop, so that is constructive. Very mixed price action. I think the markets overall are just digesting here for the most part, digesting all of 2024's gains. But we are seeing some signs of life, and earnings are definitely coming in better than expected. And then for the RTY, I actually really like how the RTY looks right now. I think you want to buy these wicks down despite the price action we're seeing, and you just want to look to higher prices. We're seeing relative strength in the broader market. I mean, look at the S&P 500 down 0.43%. Look at the RSP. Look at the IWM. Look at mid caps. Look at small caps. And we've seen this outperformance for the better part of 2024. All in all, guys, I think you really just want to take the opportunity we have right now. If we do get massive pullbacks like we did early on in the week, buy those dips with fury. And when we get days like today, digestion days or highly volatile days, don't make any moves. Sit on your hands, sit through the volatility, and let the market do its thing. And looking at some of the big tech name earnings, now Microsoft released their Q2 earnings on Wednesday. They beat expectations on the top and bottom lines, but revenue for its Azure business fell short of estimates, and the stock at one point was down as much as 5.55%, seeing a little bit of a recovery right here, but down 3.34% for the day, including the after hours move. Bit of a dumpster fire right here. Now, the company reported cloud revenue of $40 billion for the quarter. It reported $40.9 billion. The street was expecting $41.4 billion. So yes, a pretty big miss right there. Investors are really banking on this segment of the business to grow much more and deliver growth and value for shareholders. And that is why the stock was down 5%. Not a good look for Microsoft in aggregate. Tesla was down as much as 6% in after hours. The company missed Wall Street's estimates for fourth quarter earnings per share and fell short of several other key metrics. But considering the stock rose 250% into these earnings, seeing a 4% pullback right here is really inconsequential. Now, Tesla reported adjusted earnings per share of 0.73 cents in the fourth quarter. The street was expecting 0.75 cents. Gross margins missed expectations as well by nearly 200 basis points. And Tesla's operating income came in at $1.5 billion. The street was expecting $2.7 billion, an actual dumpster fire of an earnings for Tesla. If this stock was any other stock but Tesla, it'd be down like 10, 12, maybe 15%. But because it's Tesla and his proximity to Donald Trump, we're only seeing 5% pullback. This should be down like 15%. This missed top line, bottom line, missed gross margins, missed earnings, missed operating income, missed all of the key metrics. And this is the reaction. Absolutely crazy. The stock is totally decoupled from fundamentals, and IBM shares were up 11% here today, guys. Now, this is in the after hours move, up nearly 10% for the day. Now, IBM beat on the top line, beat on the bottom line, and AI bookings were very, very strong. IBM projected constant currency revenue to grow 5% in the full year, above estimates for 4.81%. Meanwhile, the company forecasted free cash flow of $13.5 billion for the full year, well above the street's expectation of $12.9. IBM also said its generative AI book business now stands at more than $5 billion. So we're still seeing AI demand, but not so much in the hyperscalers, more in these smaller broad market names, stuff like IBM. Very good earnings, and Meta's earnings is not out just yet, but I don't have time to cover that. We will cover it in tomorrow's video. Or go to my Twitter, guys. Follow me there. I'm going to have a write-up on Meta's earnings. And diving into sentiment, this is Goldman Sachs Equity Sentiment Indicator, which combines 9 measures of positioning across institutional, retail, and foreign investors, and has historically been a statistically significant signal for near-term S&P 500 returns. And we have seen a pullback in sentiment quite significantly here in the month of January. It really goes to show the sentiment shift we've seen. However, we are not below the zero line, which means markets are still slightly longer than what they were 12 months ago, although we are not in the stretch positioning area, indicating to us that this is definitely a time for us to start adding if you haven't already. And guys, sentiment pulling back like this is simply opportunity. And while multiples today appear expensive, when compared with historical averages, these valuations are supported by the strength of the current macro environment and the corporate fundamental environment. Taking these factors into account, the multiple of the US equity market, pretty much the S&P 500, is almost exactly in line with fair value. This is according to Goldman Sachs. In other words, Goldman Sachs believe that the S&P 500 is trading at about its fair value. And generally speaking, the rule of thumb is when a stock is at fair value, it will appreciate no less or no more than the earnings it is set to return in the next 12 months. So The S&P 500 consensus growth estimates is for 14% in earnings, so you could expect about a 14% return for the S&P 500 this year. Now, do take that with a grain of salt. That's just financial theory. Markets don't work that efficiently, at least not on paper. Nonetheless, when earnings are growing, stocks tend to do very, very well, especially when they're undervalued or at fair value. And the S&P 500 is set to see 2025 consensus growth 14%, mid-teens growth, the Nasdaq 100 20% growth, the Russell 2000, the biggest of the bunch, 42.6% growth. You can see value stocks double digits as well, ever so slightly, and even Europe, Japan, China looking at modest growth, and emerging markets 16%. So look, the place you want to be is definitely the US markets, because why would you hold any other stock when you can just hold the S&P 500 and get 14% earnings return? Now, a lot of you are probably thinking, these are just consensus growth estimates. What if we don't hit these growth rates? And collectively, analysts are actually surprisingly accurate at forecasting earnings. Now, FactSet recently measured earnings per share for S&P 500 companies at the beginning of the year versus what they actually reported for the full year in the past 25 years, excluding 2001, 2008, 2009, and 2020, because these are arguably outlier years. And the average difference in EPS between the periods was simply 1.1%. So in other words, you could say that the S&P 500 is expected to see earnings growth 13 to 14% if you use that margin of safety. And this is probably what you can expect in the S&P 500 this year, 13 to 14% growth, assuming the S&P 500 is at fair value. And if the macro environment holds up, and to be honest, it simply is. We saw another tick up in the Fed's GDP now to 3.1%, robust growth. We are going to report preliminary figures for GDP tomorrow. We'll see where this stands, but 3.1% growth, well above the blue chip consensus. I think we're going to see about 3%. The market is very, very hopeful for good growth. And also, we are currently seeing unemployment at 4.1%. This is roughly full employment, and the current economic context is very strong and actually quite rare. When you have a combination of low unemployment and strong GDP, this type of environment has only occurred about 6% of the time historically. Prior episodes occurred in 1965 to 1969, which are all of these green dots right here, as well as the late 1990s, these purple dots right here. This is where we are in 2023-24. And in these prior episodes, we saw very strong and robust equity performance. In other words, guys, we are in such a rare economic environment, and in an environment like this, you want to be long risk assets. But ultimately, the thing that's going to move everything this week is earnings, and we definitely saw it with stuff like ASML, ADP, Microsoft, the works. However, that is today. Tomorrow, we have another stellar group of earnings. MasterCard's reporting, Dow, UPS, Blackstone Company, Nokia, Southwest, Allegro, Caterpillar, Comcast, Mobileye. They're all reporting before the open. And then after the close, we have Apple, Intel, Visa, KLA, CN, Atlassian, Baker Hughes, Decker Brands, United Steel, SkyWest. Absolutely crazy day on Thursday, which coming off a crazy day here on Wednesday. And guys, tomorrow, the data keeps coming in. We have the GDP growth rate forecast. The market is penciling in 3%. I think anywhere from 3 to 3.1%, and the market is going to rip on that result. And then Friday, we got the inflation data. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.